Hello. Hello, everyone.
Hello, Professor.
정인박. Okay. My eyesight is really poor. So you guys had a lunch? Decent, not hamburger, not fast food, decent food, decent meal. Where is this place? Where is this? Is there anyone who have been to here?
Venetia.
Sorry?
Venetia.
Yeah. Venetia, Venice, right. Venice. So this place, this city has something to do with financial statements. Historical place in many ways. So one of the works by Shakespeare is The Merchant of Venice, right? Is that right? Is it written by Shakespeare? Not sure. So Italy is the birthplace of the Renaissance period, right? And Venice is the capital of commerce at the time, right? So, the Venice, the merchant in Venice was kind of invented the double booking system, double entry, to make their transaction much easier and accurate, right? So that's why I took some picture of this city, Venice. Anyone who been here? I never been to Venice. Anyone? As I understand, no one came from Italy. I've never been to Italy. Anyone who been to Italy? No? Oh, Bombeni. This I can read from the screen. Could you tell me could you share your experience in Italy with us? Bombeni?
It's just Benedict. I just logged into my iPad because it was faster. Yeah, I've been to Italy a few times.
A few times?
Yeah.
Ah, okay. So on what occasion?
Just vacation with parents.
Oh, just vacation from Paris. Ah, how far is so do you take a flight or by car or?
We from Germany we flew to Italy, but we took the car back from Italy to Germany.
Ah, okay, I see. Yeah, must be great. Must be great. Yeah. Okay. Yeah. So Europe. Yeah. Yeah. France, Germany, and Switzerland, Italy. They are all kind of make a cluster, right? Yeah. Great. Great. I hope one day South Korea is unified, reunified, and we also go to Europe through North Korea and China, Russia. I mean, okay, welcome back. Nice to see you guys again. Okay, last time I misunderstood. I the class is supposed to be end at 4 p.m. right? But I may misunderstood. So sorry about that. So today the class will end around 3:55. Yeah, because some of the students have next class. Okay, so this picture is from Venice, in Italy. As I said, according to some historians, the merchants in Venice invented a double entry. You know, as I understand, most of you guys took accounting class, right? So debit and credit was invented during the Renaissance period in Italy, especially specifically in Venice. Okay, just for your trivial knowledge. Okay, so lecture 2. Today we are going to talk about understanding on financial statements. Okay. So I think most of you know what financial statements are, right? So Yejin, hello.
Yes.
Okay, so okay. So what are the financial statements?
It's kind of information regarding the corporate financial performance.
Right. Yeah. So financial statements includes the performance of the company over some period and the financial status of the company at some specific point. Okay. So that's right. Yeah, you are correct. So the company released some statements, many statements. Among them, one of the most important statements is a financial statements. Okay, the financial statements consist of several statements. Okay, so this is article I took from Wall Street Journal yesterday. This article just a little bit, okay, a few weeks ago. So Tether is because you guys have some interest in the cryptocurrency. So I think this article is related to a financial statement. So Tether is one of the cryptocurrency, which is there are many types of cryptocurrency, but Tether is so-called stable cryptocurrency, because one Tether, the cryptocurrency is equivalent of $1 US. So they are supposed to have, so the Tether, the company is supposed to have reserve $1 US when they issue one Tether cryptocurrency. So on the financial, so this company is asked to release their financial statements by the investors. But as you can see here, the many crypto companies lack basic financial guardrails. Tether needs an audit that's akin to a corporate coloscopy. So financial statements is like looking into the details of a financial status and financial performance of a company, right? So even this, the cryptocurrency companies also need to have prepare a financial statement for the investors, because of all the investors, the cryptocurrency holders will will be interested in the financial soundness of this cryptocurrency company. Okay. Okay. But the problem with the cryptocurrency company is that they are not regulated by the financial authority like SEC. So that's the problem. Anyway. Okay, so the financial statements consist of mainly 4 statements. So the first one is a balance sheet. The financial statement, the balance sheet, income statement, and the statement of cash flows, and changes in the retained earnings. Those financial statements was not invented at the same time, right? So this balance sheet was first invented by, I don't know, someone. And if you look at this balance sheet, you can find the balance sheet basically shows the accumulated financial status of the company, okay, at some specific point. Okay, so from the inception of the company to the specific period, let's say June 30, 2020 or December 31st, 2021, balance sheet shows what is the status of this company in terms of assets, liabilities, and shareholders' equity. Okay, that is the that is the identity of the balance sheet. Everybody knows about that, right? Okay, so on the balance sheet you can see assets, current asset. Can you guys see this statement? The letter is just so small. Is it so small? So small?
No, it's fine.
Can you guys see? Can you guys read these small letters?
Yes.
Yes, no problem.
Oh, okay, good. Even I can see. Yeah. Okay. Asset, current asset, long-term restricted cash. Okay, current asset, long-term restricted cash, mainly current asset and the property and equipment, and lease, goodwill, long-term lease. Yeah, so this company, Coupang, everybody knows Coupang, right? Delivery company. So this company, in this asset side, Coupang has the asset side consists of current asset and the long-term restricted cash and property and lease, goodwill, long-term lease deposit. This is kind of a typical components of asset, okay? And then actually liabilities and shareholders' equity is in the right side traditionally, if you look at the traditional balance sheet. But these days, they just show this just in one column, right? On the liability side, you also have current liabilities and the long-term debt, okay? And the long-term operating lease obligations and defined severance benefits and others. So current liability mainly, and the long-term liability, long-term debt, okay? And then if you, the balance between, the balance of, the balance is shareholders' equity, okay? The shareholders' equity is asset minus liabilities. Okay, so if you look at the shareholders' equity, you can see stockholders' equity and additional paid-in capital and accumulated other comprehensive income or loss and accumulated deposit. The coupon is in the seriously in a deposit position at the moment. So from this balance sheet, this company has a huge amount of asset and huge amount of liability, but liability is much higher than assets. So that's why the shareholders' equity is in the negative. No, not negative. Yeah, they still have a lot of paid-in capital. So basically, their shareholders' equity is in the positive territory. But they are, you see, they have accumulated not profit but deficit, right? It means that this part comes from income statement, okay, basically. But let's look at first the balance sheet. Okay, so if we the typical the balance sheet looks like this. So on the left side, asset, right side, credit side, you have liabilities and the shareholders' equity. Okay, and asset mainly consists of current assets and fixed asset. Fixed assets such as property and equipment or building. Okay, so tangible fixed asset, intangible fixed asset. Tangible fixed asset is a building or property or plant, something like that. Intangible fixed asset is goodwill, for example. Okay, and on the right side, liabilities, current liabilities, long-term debt, and shareholders' equity. So you see this net working capital. Net working capital is, just a minute. Net working capital is the difference between current asset and current liability. The net working capital is the capital you need to make. You need to have the company working. Okay, so mainly that's why the net working capital is calculated by deducting current liability from current asset, because current means working asset, working liabilities. Okay. Any questions? Pretty easy. Okay. This is balance sheet. The balance sheet forms accounting value on a particular date. Okay. So the company has incorporated at some point or day one. Okay. Day one, and they started doing business, right? And then at some point, at this point, right? You want to know the financial status of the company. Then you need to look at balance sheet. So this balance sheet, all this amounts on the balance sheet is accumulated amount from the day one up to this period. Okay, so all the performance is represented in the on the balance sheet. Asset left hand side, liability owners equity right hand side. But these days, they show in just one color. Net working capital is the current asset minus current liability. This is important, okay? Because at the end of the day, the balance, the corporate finance, finance is all about, in the end, the cash, right? Cash flow. So working capital is important to calculate the cash flow. Okay. So working capital is current asset minus current liability. Okay. As I said, the working capital is a measure of company's liquidity and the short-term financial health. So the company needs this capital to the business, right? So if you don't have enough current asset, if you have too much current liabilities, too much liabilities without too much liabilities, then in some extreme cases you may not be able to service some interest, right, on the loan. So then the company is going to default. So that's why the current net working capital is very important. So one of the ways to measure how the company, in terms of working capital, the company is sound. One of the ways to know how sound the company is in terms of working capital is to calculate the current ratio or quick ratio. The current ratio is calculated dividing current asset by current liability. Okay, so if the company is sound, it should be higher than 1, right? I think so. And then if you really want to know, the current asset include inventories. So if you exclude inventory, then you have a more focused on the asset more quickly turned into cash, right? Because usually the inventory takes time to turn into cash, because you need to deliver, you need to move the inventory to some place, the selling place, and you need to take time until the customers picks up the product. So if you deduct inventory from a current asset and then you divide it, that asset, if you divide the asset by current liability, then we have a quick ratio. Quick ratio is maybe a little bit stricter measure of the soundness of that working capital of a company.
Professor, I have a question.
Okay.
Professor, I have a question. What is BC? BS?
BC?
BS. Day 1 and BS. I was making notes, didn't have time to write it.
Balance sheet, sorry.
Balance sheet, thank you.
Balance sheet. Yeah, balance sheet. BS. This is not that BS, okay? Okay. Any question up to now? Okay. And from the balance sheet, you also this is balance, right? So the reason I explain this ratio, this net working capital or liquid reserves is that when you we usually say, oh, can you read the financial statements, right? People sometimes ask, do you read the financial statements? So then the reading of a financial statement actually means analyzing the financial statements in terms of the net working capital. How whether the current assets is higher than current liability. So then, this company has no problem with the working capital, or may have some more problems with working capital. Or sometimes you may simple calculation, make a simple calculation like this to get a quick current ratio or quick ratio. So that is actually means I can read the balance sheet, right? So another way to read the balance sheet is to find the liquidity. So liquidity, liquidity means that how rare the company can turn the assets into cash, right? So if the company has a huge amount of fixed assets, such as the buildings or some real estate only, then they may not be able to easily cope with some credit issues, right? They don't have enough cashes. So the liquidity is also very important in case of some emergency situation. So one of the ways to find out the level of liquidity of a company is to look at the solvency level. Okay, so what is the level of liability in terms of total assets? So the one of the ratios is a total debt ratio. If you divide the total liability by total asset, then you get total ratio, right? If total ratio is higher than 1, then the shareholders' equity, right? Shareholders' equity is going to be negative, right? Minus. Or the other way to look at the solvency is to calculate the debt to equity ratio. So simply you divide the debt by equity. Okay, let's see here. Debt. Okay. Total debt. You divided this. It's equity. Right? The debt to equity ratio. Or you can simply use this debt ratio and divide 1 minus debt ratio. Because debt equity asset, right? So if the debt ratio in the total asset is, let's say, 0.3, then equity is simply 1 minus 0.3 and 0.7, right? So that's why debt to equity ratio, if you know the debt ratio, you can simply calculate, in this case, 0.3 by 0.7, right? If the company's debt ratio is this case, then this company is financially sound. Okay. Easy, right? Too easy. Okay, market value versus book value. So book value, market value is not the same in most cases, right? Book value is based on the historical cost. So all these numbers, all the numbers and on the balance sheet is based on the historical cost. And the numbers are recorded in accordance with accounting principles, like generally accepted accounting principles. All the countries have their own local general accepted accounting principles. Or these days, many multinational companies follow international financial reporting standards. So they are all based on historical cost. So this is gonna be book value. So book value does not easily change because this is historical, based on historical cost. Okay. Unless there are some significant events that may affect the historical cost. But market value is the price that may be asked or bid in the market between non-independent market participants, not related participants. Okay, economically independent participants. So what would be the price of an asset if economically independent market participants buy or sell or exchange? That is the market value. In this case, book value, current asset is a little bit high. If you look at market value, a bit higher. Current asset, net fixed asset also higher market value. Long-term debt, and yeah, so the balance comes from 200, right, and the 300, right, the difference. So shareholders' equity is 1,100. Yeah. So based on this market value of current asset and the fixed asset, the shareholders' equity, market value of shareholders' equity higher than book value by 500. But this is the case where the shares are not traded in the stock exchange. In case of a Coupang, right? You see, their shareholders' equity is about 2 billion. Okay. But their market capitalization is about 29, about $30 billion. Okay. Why? This is because of all the expectations of this company, not just based on the expected market value of asset, current asset or fixed asset, about a whole business model, or not just the fixed asset, but also intangible asset and the future expectation of the company. So if the shares are traded in the stock market, the market value could be significantly different from the book value of the company. But if the company is not listed on the stock exchange, then it is really hard to figure out what their market value is. So then you may, to find out the market value, you may hire some accounting firms, or other the licensed operators. Okay, so I'm the only one who talk about these financial statements, because if you're just only listening mode, that is going to be really boring, right? Anyone who is interested in Coupang stock? No. Okay. Anyone? I don't know. Okay, I got this information from Wall Street Journal, and you know what? The corporate finance is very, very closely related to the stock market or bond market, or even derivatives or currency, the foreign exchange market. At the end of the day, we are talking about the market, financial market. Okay, so as I said in the first class, you have to be familiar with all the economic related, business related journals or newspapers or media or whatever. Okay, so then who knows, there among you guys, there will be in the future another Warren Buffett. Okay. So Coupang is listed in the New York Stock Exchange, and right now the value of one share is $16.63, and the market capitalization is about $30 billion. And we want to talk about EPS, earnings per share, a bit later, the next slide. And okay. Clara?
Yes, Professor.
Do you know what shares outstandings are?
Sorry, can you repeat it?
Shares outstanding. Do you know what shares outstanding are?
No, I don't really know.
Okay, no problem. Yeah, no problem. The shares outstanding. Anyone who knows about shares outstanding, what does this mean?
Shares that have been distributed in the market.
Yeah, right. Correct. Shares, basically share, not just the market, the shares that are issued to the shareholders. And some shares could be, some shares are traded in the stock market, but some shares, even some shares are not. Some share, okay, basically shares outstanding is all the shares issued to the shareholders, okay? And okay, shares, okay, these are all shares outstanding here. Shareholders equity portion, you see? So this is total amount of shares outstanding. The shares outstanding is that you issued a share, for example. This is company and the shareholder. So you issue share, stock, okay? A share of stock, a share of stock. And then the shareholder is gonna be shareholder, contribute money to the company, right? So, this person, investor, has a shareholders right? But the company is not obliged to pay back this investment, equity investment to the investor, but but in some sense, this amount is kind of a debt, okay, kind of debt to this investor. So that's why all the shares issued to the equity investors is called shares outstanding. And then these shares could be floating in the stock market, like New York Stock Exchange, or some shares are not traded in the stock market, but just held by some private or institutional investors, equity investors, okay? But they are all shares outstanding, okay? Okay, so public floating is 1.1 billion shares. Okay, now we are gonna talk about income statement. This is consolidated statement of operations. So income statements basically shows the performance of a company. Okay, so company started and exists up to now, right? So then if you want to know some performance of a company during some specific period, okay, during this period, or this period, or this period. If you want to know performance of the company for some specific period, you have to see income statement, this statement of operations. Okay, so you can see a sales revenue or other revenue, and you can see total revenue and and then you can see the cost of sales, and then you can see the total cost, and then actually you are supposed to this company is in loss. Gross profit. If the company is profitable, okay. The coupon is in gross, not on the profitable situation. Gross profit, and then if you operating loss, the company is right now operating, okay. Gross profit or operating loss, and you have to, or you want to also have some financial cost, interest income or interest expense, and then you want to have after other income expenses and taxes, you want to have net income or net loss, okay. And this is earnings per share. Okay, so revenue and cost of sales and gross profit and other expenses, then taxes and net income. So I think you guys may heard about EBIT. Have you guys heard about EBIT? No? EBIT is earnings before interest and tax. Okay? Earnings before interest and tax. Before tax, so earnings. So basically operating income or loss is so-called EBIT. Okay, so this is a very important. So operating this line, operating loss, operating profit. This is not gross profit. Gross profit is around, should be around here. Okay, gross profit, gross profit or loss, gross or loss. So here, operating. So after other administrative expenses, SG&A, you're gonna have operating loss, operating profit. So this line is very important. Because why? Because this shows the this up to this line, you can see. I mean, these numbers are basically shows the performance of the company. The numbers below this line, interest and tax, is not much related to the operation of the company, right? That's why operating loss, operating profit is important. So we call it EBIT, earnings before interest and tax. Interest and tax is not much related to the performance of the company. So earnings before interest and tax. Okay. Earnings per share, we're gonna talk about a little bit later. Okay, so you want to read the income statement, right? So income statement is basically forms the performance over a specific period, okay? And then if the company is a manufacturing company, if the company manufactures some goods, then the most important thing is to make sales of the inventory, right? Make sales of a product. So you may want to know how rare the company sell the inventory, their products. So then inventory turnover. Inventory turnover is going to be maybe the first ratio you may be interested in. In terms of finding out the performance of the company, right? So how to calculate? You divide the cost of goods sold by ending inventory, right? So then you can get inventory turnover. So if the inventory turnover is, do you think? Let me talk with you guys. Look, is it okay? Okay. Bai, Louis Bing Bai.
Yes.
Okay, so you are from
China.
China. Okay. Which city?
Tangshan. It's from Hebei province.
Hebei province. Hebei province. In the north or south?
North.
North. Okay, I see. Okay, so do you think inventory turnover inventory turnover should be higher or lower when the company's performance is good?
Maybe higher.
Yeah, so inventory turnover should be higher, right? So if the inventory is higher, then the better. Okay, so based on this inventory turnover, the company made decisions on pricing or level of manufacturing, or they may decide on the marketing strategy. Because if the inventory turnover is high, then your product is very popular, right? So then you may think of additional markup on your price, right? Or marketing maybe, I don't know. I'm not an expert in marketing. So if the product is very popular, then you may be more aggressive in marketing or whatever. And the purchasing new inventory, if the product is very popular, if the inventory turnover is very high, which means very popular, then you may need to purchase more inventory, a raw material inventory, right? Something like that. So they are related to all sorts of other decision makings. Anyway, but I mean, marketing department and the purchase department and sales department, all they're gonna look at sometimes at the financial statement, especially this inventory turnover. Okay, depending on their position. Yeah. So it is also important to know how long it takes to sell. How long it takes to sell the inventories, right? If the lead time is very long, depending on what product you have, if the product is, I mean, if the product is fresh, some agricultural products or dairy product or something like that, then lead time should be very short. So depending on the product, their days to sell the inventory is also very important. So how to calculate? You divide 6. It depends. Not always 1 year, but you can sometimes choose another period. But for example, if we take income statement or annual income statement, then you should, if you divide 365 days by inventory ratio, this inventory turnover, okay, inventory ratio, inventory turnover, okay, this one. Then you can get days to sell inventory. So is it good? Long? I mean, the longer the better, or the worse? Yeah, the worst. I mean, nobody wants to keep the inventory for a long time in their warehouse, right? Sometimes they may keep, not always. It depends. Let's see, our products. You expect that your products to be very popular, very scarce in the future, right? In the future, so then you gotta keep the inventory at the moment, and then you want to sell the products at the time when the price is hitting very high, right? So not always. No, I mean, sometimes it is good to. They may strategically keep inventory very high, so then the days to inventory may be high. So sorry. Hey, I made a mistake. So if the inventory ratio is low, the inventory turnover, usually short is better. Yeah, shorter is better. I think so. The longer is not, the worse. Usually, that is the case, usually. Okay. That's like, okay, I'm not gonna be too much serious about this. Okay, profit margin. Profit margin is calculated dividing net income by sales. Profit margin is very obvious, right? So how much margin you take from the sales of a product, okay, or service, whatever. So profit margin, the higher the better, obviously. And the return on assets, you can this is a income statement side. This is the balance sheet side. Okay, you should, if you want to calculate the return on assets, you should look at income statement, not just the income statement, but also balance sheet. Okay, so if you divide the net income by total asset, you can get return on asset. Oh, how effectively your asset generating net income, right? So then from this ratio, you can see how much productive your assets are, right? Return on asset. So all these return on equity is how profitable your shares, the equity is. So you can see from this return on equity. Okay. Earnings per share is simply you divide the net income by number of shares outstanding. So depending on your perspective, depending on your needs, depending on your position, depending on your perspective, you can take some ratios that may give you the most effective information. Okay, so yeah, here's some ratios. I took this from textbook. So try not to memorize all the ratios, just some important ratios. But I think you don't have to memorize this because it is very logically very intuitively very understandable. Okay, so it looks like a lot of it looks like a little bit yeah, it looks some some receivable turnover also you need to okay, so please take a look at most of the ratios. Okay, so I didn't touch on all the ratios, but just some of them. But if you have any questions with understanding some other ratios, then please let me know. Okay, but mostly I think understandable. I'm gonna talk about a little bit a bit more ratios in the next slides. Inventory power up, Aniji shoppers food retailers in Japan. I also took this from a journal. Right, inventory power up. So during the pandemic period, the consumption, I mean, the consumers' spending skyrocketed. So because they just combined it at home, so or most of them, all they can do is just to purchase or new furniture or new appliances, something like that. So, or after pandemic, all the revenge consumption pushed the retailers to pile up their inventory. But these days, the inflation is getting higher and higher, right? So retailers have some, it's going to have some problems. As you can see here, chains have a lot of goods heading into big sales period, just as some shoppers are pulling back. Why? Because of inflation. So then inventory piles up. When inventory piles, then inventory turnover ratio is going to be low, right? So then days to sell is going to be higher, right? Something like that. So then profit margin may be lower, right? So from the trends of inventory turnover, you can also see what is the market reaction to the product or services of the company, right? Something like that. So that is how you read financial statements. Okay. Any questions? No? Okay. I think this guy should lose some weight, right? Sorry. What is this? What is this? What's this? I didn't do this. And hey, is there someone who did this? Please get rid of this, please. Please. Oh my God.
Professor,
Uh-huh.
it's a delete function. To delete it, you have view options on the top of your screen. There is view options.
Option.
Yeah, like on the top of your screen, near to your viewing someone else's screen, like green, view options, and they will be annotated, and you can like delete as a host.
Yeah. Okay, just a minute. Okay. Thank you very much. Yeah, thank you. Okay. So from a corporate finance perspective, non-cash items, as I said, we're going to talk about cash flows later. So income statement, there are some cash, some items are directly paid in cash, but some are not. So there are some non-cash items, especially the biggest non-cash item is not here. It does not show in this statement. The biggest non-cash item is depreciation or amortization. So this non-cash item is important in calculating the cash flows, because you have to add back this non-cash item to calculate the cash flow. Okay. Okay, so that's another thing you should get from income statement. And earnings management, where this is not okay. So if you are expert in accounting, general subject accounting principle or IFRS, if you are very if you are the accounting expert, then you may know many ways to inflate or deflate or smooth the earnings of the company's performance, right? So that's what it said. I mean, that's what the earnings management said. So the investors, the investors hate surprises. They don't like surprises, right? 1 year performance is very good. Another year performance is poor, good, poor, good, poor. They really hate this kind of performance. What they really love is gradual growth, gradually increasing performance. They really hate the surprises. That's why earnings management is very attractive. But as far as you can your earnings management in line with accounting principles, then could be okay. Okay. Now we are about talk about taxes, because you can see there are income tax expenses, right? corporate tax and the tax rate. Corporate tax is the tax paid by the corporations, right? So Korea's corporate maximum corporate tax rate is 25%. That's what I understand, including local tax, maybe 27.5%. Many European countries may have a higher tax rate, higher corporate tax rate. So, but we are not going into much details about on taxes, but just some tax rates. That's all. Marginal tax rate is the amount of a taxpayer on the next dollar on. Okay, so tax rate. And range, income range, profit range, taxable income, taxable income range, right? So if the country has a progressive tax rate system, which means that as the more you make money, the higher tax rate will be applied to the taxable income. So let's say 0%, 10%, 20%, 30%. So 0 to 10 million, 10 million to 20 million. 20 million to 40 million, 40 million, right? So marginal rate. So if the company is in this range, right? In this range, the marginal tax rate would be 10%, right? So if the company has additional, let's say. This year, the taxable income is 21 million. So then 20 million plus $1. Okay. So then this $1 marginal tax rate is 20%. Right? This is marginal rate. Average rate is simply total tax paid divided by total taxable income. Any questions? Pretty easy. Okay. All this content on the slide come from the e-textbook. So I don't know. You don't have to take notes. I mean, yeah, passionately. So just try to follow the flow of the class. Yeah.
Sir?
Yeah.
If we didn't pay all the total tax income, that means that we do some, that we steal some money or do some sketching?
If
the average rate is not 1, what does that mean?
Could you say again?
If the average rate is not 1, then we don't pay all the total tax income.
You mean to 0%?
Yes.
Yeah, up to 10 million. If this is the case of tax rate, the tax rate, the tax table. So then from 0 to 10 million, yeah, no tax. Yeah.
Okay.
Most countries, if you look at the tax rate, there's always exemption range. So, but nobody wants to be in this range. They want to make money and pay taxes. Any questions?
Yes, Professor. What about small and medium business? Do they also pay according to your table?
Small and medium business?
Yeah, for example, chicken cafe or Fajuma.
Shiktan.
Yes, in Shiktan.
Yeah, small and medium. If as far as the small and medium, even if the size is small and medium, as far as the company structure is a corporation. Okay, if the size doesn't matter in most cases. What matters is the form of organization. So if the organization is a taxable entity, for example, corporation, Korea is called Jushkesa, or in Germany, you're from.
I'm from Russia. In Russia, like,
Russia. So then
people prefer to pay taxes. So
so Russia? Then what is the corporation in Russia? I mean, like in the UK, the corporation is no. I mean, in the US, the corporation is CEO or company Ltd, something like that, right? Or in Germany, it's GmbH. I don't know. Yeah, and China. And Chinese character, and yeah, Russia. You may have some a form of corporation, right? So whether it is small or medium or large, as far as the company has the taxable entity, the corporation, then they should pay tax, and the tax, the amount of tax is depends on this tax table. So where the taxable income lies in this table, right? Okay. Paulina, is that okay? Okay. Okay. Next slide. Cash flow. Actually, the star, right? The star always come last. Okay. The most important person, MVP, comes always last. So today's MVP, VIP, sorry. Today's VIP is cash flow, okay? So now we have a cash flow. So cash flow is all about, finance is all about cash flow, okay? Cash flow. The cash come from, okay, here, balance sheet, BS, asset, liabilities, and the shareholders equity. Shareholders. So cash come from asset, liabilities, and shareholders. But we are not focused on cash from assets. Okay. Cash from liabilities, where, for example, if you go to bank and borrow money, and then you have cash, and the money you have, the cash you have, you get from the bank will be recorded on the liability as a short-term debt or long-term debt, right? But we are not talking about those cash. Or you can have cash from shareholders by issuing shares. but we are not at the moment talking about the cash from the shareholders. You can have cash from asset by operating assets, right? For example, manufacturing goods and manufacturing goods and selling them to the customers, right? So we are gonna talk about cash flow from asset. But at the end of the day, asset was financed by liability, debt, and the shares. But anyway, the performance comes from assets. So cash flow from asset operating. So what types of so the cash flow from asset consists of operating cash flow. This is mainly should be positive, right? And capital spending, you may spend some money to purchase some fixed asset or other asset, right? Capital spending minus, and the changes in working capital. That working capital is consisted of current asset, current liability. Current asset is mainly some cashes and account receivables and inventory, right? So and the current liability is short-term loan and accounts payable, right? So depending on the changes of the net working capital, the cash flow also change it. For example, let's say you're gonna purchase some raw materials, but you're not instantly pay for the raw materials, right? So then you're gonna have accounts payable. But the later you pay for the raw materials, the longer you're gonna keep the cash in your bank account, right? So likewise, for example, so if current asset is higher than current liability, then cash is gonna be the cash flow also changes. Okay. So usually account receivables means that you have less money because you haven't yet collected cash from the sales. So if the current asset is higher than current liability, then your cash balance is getting lower. Okay. And after these three cash flows from asset, plus or minus, right? Then you're gonna have a free cash flow. So after you calculating on the cash flows related to operations and purchase of fixed asset or other asset and working capital, you're gonna have a balance of cashes that are free to distribute to creditors, for example, banks and the stockholders, shareholders. So this free cash flow is really these investors, creditors, shareholders really keen on this free cash flow. The higher the free cash flow, the happier these investors. Okay. So corporate finance corporate finance is finance, right? Corporate finance. So who's going to finance these corporations? Creditors and stockholders, right? That's why we are very keen on free cash flow, as they are. Okay. This is how to calculate operating cash flow, capital spending, changes in the working capital, and at the end of the day, free cash flow. Okay, free cash flow is the same as cash flow from assets. So operating cash flow, earnings before interest, tax plus. This is non-cash item, right? Hey, Jongin?
Yes, Professor.
Why depreciation is not cash item?
I don't know.
Okay, so you guys should have asked the question when I said depreciation is non-cash item. Please ask questions whenever you have some doubt. Let me ask. Some of you guys' names pretty long. Angie and Enheim Tiana.
Yeah.
Oh, do you have a short name?
Just Anne.
Anne. Okay, Anne. Thank you.
Depreciation is non-cash because the value of the asset it decrease over time. So you don't lose money. So it's a non-cash item. I don't know how to.
Yeah. Basically, you're right. So depreciation is the cost. Okay. You purchase depreciation usually take as you said, the depreciation usually made to the fixed asset. A fixed asset used for business. For example, machine. Okay, you want to use machine for business, right? So then, but the more you as you use a machine, the machine is gonna vary, right? So let's say you purchase a machine, new machine, right? So then $100. So you pay the cash of $100, right? And in return for you purchase the machine, $100. But under the accounting principle, you cannot, in some cases it's allowed, okay? But in most cases, you cannot expense this $100 on the income statement, okay? Only as you use this machine, part of this cost, $100, will be expensed in the name of depreciation. Okay, so if the machines are useful life, let's say accounting principle has a specific, based on the company policy. Okay, let's say useful life of machine is 5 years. It does not mean that in 5 years the machine is going to be useless, but just the accounting purposes, right? 5 years. Then every year, $20, right, will be expensed on the income statement as depreciation. But this $20 expense of depreciation expenses is not an expenditure of cash, right? That's why we add back this depreciation expenses. And in most cases, the manufacturing company has a huge amount of fixed asset. That's why depreciation is the biggest non-cash item. Okay. Okay. And EBIT is earnings before interest and tax. So interest is usually paid in cash, right? But interest usually paid tax, and basically we tax also part of the operations. We consider tax also part of the operation. That's why we also deduct the taxes. So earnings before interest and tax. From the earnings before interest and tax, we also deduct the taxes, because the tax are also part of the operations. Oh, we don't have enough time. And the capital spending is the ending net fixed asset and the beginning fixed asset plus depreciation. You should understand why we also minus deduct depreciation. I'm going to ask next class. And the change is net working capital, ending net working capital minus the beginning net working capital. Pretty obvious, right? And the free cash flow, I'll be EBIT plus this one, operating cash flow, and net working capital, this one. Oh, this one, and then capital spending, right? So if you combine all three, then you have free cash flow. Oh.
Professor, we are sorry. We are having next class in 5 minutes, and we need to go.
Okay. Is that okay to keep going? Okay. And DuPont analysis. DuPont analysis is also important.
Professor, we're sorry, but a lot of us have a class starting right at 4. So we need some time to go to the class because we have some more classes after this one.
Sure,
But it
sure. I'll keep in mind. I'll keep in mind. Yeah. Okay.
Yeah.
Okay. So I'm gonna talk about DuPont analysis in the next class. Okay. So see you next time. Financial techniques. Okay. I'm gonna take care of other slide in the next time. Okay. Any question?
Will you upload this onto the smart system?
Sure. Definitely.
Thanks.
Everything. Okay. Thank you very much. And if you have any questions, please email me. Okay. Thank you.
Thank
See
you,
you next week.
Thank you, Professor.
Bye-bye.
Bye.
Oh, okay. 명석? 명수, 리명수?
네.
Yeah. Any question?
No, I'm good. I just
Okay. See you next time. Bye-bye.
Bye.